The first qualitative characteristic to remember is relevance. So first of all, remember that it is a qualitative characteristic. Get your definitions nice and tight so you always remember the same thing and state it the same way. So relevance means information is relevant. We only include relevant information, but what does that mean? It means information is relevant if it will influence decision making by helping you either evaluate a future decision or confirm a past decision. So basically you could probably define relevance just with that. Information is relevant if it influences the decision making. This part here is good to help explain it, but you probably don't need to give those last 2 points. How do we decide whether something's relevant? Well, basically there's 2 ways. The materiality test only includes something that's material. What does that mean? It means it's large enough to influence decision making. And secondly, if I left it out or got the number wrong, that would result in a bad decision. So that is why we include, say, $1,000, but if we don't put a transaction in that's 80 cents, that's not large enough to influence our decision making. Even if we leave it out or omit it, it's not going to result in a bad decision. Another way is the entity test, not the entity principle. It's related to that. We'll talk about the entity principle separately, but something's only relevant if it's not a personal transaction of the owner or a transaction of any of the owner's other businesses. So we only want to include items that are relevant or applicable to the particular business that we're doing the books for. Looking at an example, let's say the owner of a business contributed a computer. The owner paid $5,000 for the computer when purchased 2 years ago. The current agreed value is $2,000, so that's what the current market value is today. Explain how the computer should be valued in the firm's balance sheet. So in an earlier video when we did our revision, we looked at a way to, or a structure to answer theory questions. So I'm going to identify, in this case, relevance. There may be a mark for that, there may not. So I'm then going to define it, and I'm only going to give the parts of definitions that are appropriate. So in this case, I'm going to sort of get that definition down a little bit and just write, relevance states only information which influences decision making should be included in the financial records. And I haven't answered the question, however, I haven't related this to the owner giving the business that computer. So what I'm going to do now is relate, and in this case I'm going to say they should use the agreed value of $2,000 because this will affect the firm's decision making. So as an entity, the computer should be valued at $2,000. That's what it's worth today, and that's when the business is getting it. What it was worth 2 years ago has no relevance to the business. It was relevant to the owner 2 years ago, but it's not relevant to the business today. That will help us make decisions, so we always mention that. It's going to help us make a decision. For example, how much we insure it for. We'll only insure it for $2,000. Looking at another example, what about if we prepaid insurance for the next 2 years for $240? The owner is, that's $240 total, which if you do the maths works out at I think $10 a month. Which isn't very much. The owner is choosing between 2 options when recording it. Option A, let's write the full amount off as an expense of $240 in the current period. Or option B, let's record the $240 as a non-current asset and then each period record the amount used as an expense. Suggest which option you recommend for the owner. So I'm going to identify relevance. I'm going to define it. Only include something that's going to influence your decision making. And then I'm going to relate it, and I'm going to say in this case to choose option A. I'm going to go with the option where we write it all off as an expense, so this one here. Look, really, technically the right thing to do probably is option B, but is it worth carrying an asset on the balance sheet for 2 years that's worth so little money? It's just going to clog up our balance sheet. If we listed everything that's only worth $100 or $200, the balance sheet would be too big. So I think we can forget about that. Just write it off as an expense up front. It's not going to affect our decision making, so it's not material to, if we do have an asset for $240 or don't, it's not going to affect the way our business makes decisions in the long run.